So a common bit of advice I've seen people give UK-based crypto investors is, if you're sitting on an unrealised gain and you want to mitigate or even avoid entirely the capital gains taxes on these in the UK, then you should leave the UK, lose your UK tax residency, and perhaps become a tax resident of a country which doesn't have capital gains taxes. So for these purposes, places like Dubai, Singapore, Hong Kong, Malaysia, these are quite attractive if you're planning a strategy like this. Now, in principle, the idea is fine. There are definitely ways in which you can design this to mitigate the capital gains tax charge in the UK, but there is a lot of nuances and caveats here. And unfortunately, I think a lot of people have been given advice without those nuances, because I've picked up some client cases over the past few years which they've basically come back to the UK after 3, 4, 5 years, and they've unfortunately been hit by some huge tax charges that they were not expecting. So in this video, I'm just going to give you an overview of why that was, and give you an explanation as to what kind of pitfalls, or what is the kind of main pitfall to avoid if you are doing this sort of strategy. So if you're new to this channel, I'm Andy. I've been an international tax advisor since 2014, chartered accountant since 2018, and I help you navigate the complex world of international tax. So what's the potential problem that people are facing, and what do you have to be careful of if you do apply this sort of strategy, taking your crypto abroad and cashing it out there? Well, it all relates to your future behaviour and whether you plan to come back to the UK, because there's a rule in the UK tax legislation called the temporary non-resident rule. So the temporary non-resident rules apply to individuals who have been UK residents but then leave, yet still find themselves potentially liable to capital gains tax if they come back to the UK. So how does it work in practice? Well, a temporary non-resident is someone that was UK resident for at least 4 of the previous 7 tax years before they left, and then they returned to the UK within 5 years of leaving. So what happens if you are deemed to be a temporary non-resident? Well, any gains and losses that you made in that period are treated as arising in the year that you return to the UK, and so they can be subject to capital gains taxes on your return. So, let's say you had £100,000 worth of capital gains on your crypto whilst you were in the UK. You then decided to move to Singapore, and within a few months you just cashed these out and made those gains tax free in Singapore. Now, the problem would arise if you took those gains and moved back to the UK, let's say 3 years later. Well, you'd be deemed a temporary non-resident, and that money that you basically took out of the UK system and took advantage of the tax-free status abroad can be clawed back and charged at the UK capital gains tax rates. So this can be quite devastating, especially as it all gets taxed in the 1 year, potentially putting you into high tax brackets and really just hitting you potentially even harder than you would have been hit had you just cashed out in the UK. Now, there are some exemptions. Not all of your gains would be taxed upon your return. So any assets acquired after leaving the UK and disposed of, whilst you were temporary non-resident, would usually not be taxed. So, let's say, whilst you were in Singapore, you picked up some crypto, you sold it also whilst in Singapore, and you made a gain on it. That wouldn't come into the scope of these rules, because generally what the UK is trying to do is to stop the situation of people, making unrealised gains whilst in the UK and then taking advantage of the tax residency benefits they might get elsewhere, and then they return back to the UK, bringing all this tax-free income in. That's the kind of situation that they're more concerned about. They're not so worried about you actually legitimately making some gains whilst you're abroad. So it is really just important to keep in mind, what were your unrealised gains before you left the country, and are you coming back within 5 years? If yes, you just have to be cognizant of these temporary non-resident rules and whether they apply to you. In terms of other exemptions, you can potentially, get double taxation relief. Assuming you didn't go to a zero capital gains tax jurisdiction, you might have actually had to pay some capital gains taxes on the disposal of the crypto. So, you might actually get some double taxation relief if the UK has a double tax treaty with the country that you live in. So there are some potential reliefs there. But in general, it is just quite important to just understand that, as a rule of thumb, if you come back to the UK within 5 tax years of leaving, then you do leave yourself potentially vulnerable and open to being hit pretty hard by these rules. So, as I said, this is something I have seen with people that were given advice, 3-4 years ago and told, just leave the UK, go to, a tax-free country and cash out there. And, then unfortunately they've ran into some pretty heavy difficulties on their return and some serious issues with HMRC. So you just really want to avoid that and make sure that you are carefully aware of all the kind of pitfalls you can run into, and just ensure that you do just mitigate that as much as possible. So hopefully this is a useful overview into the key pitfall that you do have to avoid if you are leaving the UK and you're bringing some unrealised capital gains with you. As you can imagine, it can be very debilitating if you do get hit by this on your return to the UK, and so very important to just understand these rules, and you just always keep in mind the rule of thumb that you should spend at least 5 years out of the UK, if you are planning to take advantage of this strategy. Now, that doesn't mean you have to physically be outside of the UK for that entire time. You just have to make sure that you're not a UK tax resident during any of the 5 consecutive years after you've left. So it's important just to check the UK statutory residency test, be comfortable with your ties to the UK, the days you're spending in the UK, and just make sure you don't trigger a UK tax residency for 5 years. And if you can ensure that you do that, then you should be fine. You don't have to worry. But like I said, if you don't meet that and you do come back into the charge of the temporary non-residency rules, then potentially all of the capital gains that you thought you were avoiding capital gains taxes on can be brought back into the charge when you go home. So really important just to keep familiar and make sure that you just don't trigger any UK tax residencies for at least 5 years, and you should be fine from that perspective. So hopefully this was useful. If there's any comments or questions, any areas that you want me to expand on, just give me a shout in the comment section below. Cheers.